All right, good morning, everybody. We have a lot of things on the economic docket today. Start with what happened around the world, though. Make sure nothing is really kicking off out there. We've seen some of that GDP report yesterday when the Atlanta Fed turned our market over around noon and sent the S&P to the downside. Still, it was moderate. You know, we didn't break out to the downside, just went back down to the open. So the ECB is getting really aggressive. Very interested to see how much more that's going to affect the market. And we're likely to hear some of that since we have two ECB speakers today. As you can see, this is kind of what's driving this move to the upside, and it's an unrealistic assumption, right? This is kind of those silly happy bubbles that we all wait to get popped. What we're looking at is the November 2 anticipated federal rate hike, and it was sitting at around 97% last week. We were talking about how it was set in stone that we were going to get a 75 basis point rate hike. And now they're unwinding that on the assumption that we're going to get a 50 basis point rate hike, less aggressive. And this is part of that pivot talk. You always got to be careful when you're listening to somebody talking about the pivot, what their definition of a pivot is. Are they pivoting away from a 75 basis point, which has been like their default 75, 75, 75, 75? We're going to pivot. We're going to hit you with a 50. Or is it a pivot away from hiking at all, where they're not going to raise rates, but they're not going to lower rates? Or is it a pivot where they actually flip over and start cutting? So when it comes to a pivot, those are like the three different classifications. The market is mistakenly assuming that the Fed is going to back off from that 75 basis point rate hike and only do a 50 basis points for November. And I believe that that is unwarranted. And I think when the news does get to them that, you know, hey, dummy, nobody said we were going to 50. Nobody said we were going to stop hitting you with 75s. We're not done yet. That the market is going to reprice these 25 basis points, and that is going to make us go down. So if you look at December, if you were to maintain the idea that we only got a 50 basis point in November, then going from 350 to 4 would be a 50 basis point rate hike. Going from 350 to 4.25 would be a 75 basis point rate hike. So with this 425, 450, you can see how they're unwinding that one as well, right? Because they don't think we're going to get 75 basis points for December. All of this is a part of why, even though we had good news come out yesterday that took a market down, right now good news is bad news and bad news is good news. We had good news come out about the GDP. The market flipped over. It didn't really go down too far because of all, well, for one reason, because of this, right? This is not the only reason. This is some of the reason. All right, as I mentioned, full house today, lots of things on the docket. Nearly every hour of the day today, we've got something to deal with. The 3-month bill announcement is something I'm going to be paying particular interest in. And then, the 52-week, yeah, I mean, this really front end stuff today. 4-week, 6 months, we do have the 7-year at 1 o'clock, but a lot of this is front week or, front curve. Not all of it, obviously, but getting it out of the way. The interesting thing, or maybe it's just a little bit scary, is when you're watching something like Finance Juice and you see how we come in, at lunchtime and the auctions are coming through and it says, say the 2-year auction, $0 million today. Like nobody stood up to buy any debt. No, none. And of course that won't go, right? There are designated banks that are going to be forced to buy it whether they like it or not. But we don't want to take it that route, right? It's supposed to be dangle the carrot, not swing the stick. So, yeah, we'll have the curve today, and we'll have those additional auctions. So we've been having the discussion about, technical analysis and how we needed this higher print so that we could get our first higher high. And we have that. But we still need to have, obviously, a pullback. We have to have a pullback. And as long as that pullback doesn't cross 3650-ish, right, this lower pivot point down here, as long as we stay above that lower pivot, then everything is fine and Bob's your uncle. But once the market starts to see that we're likely going to get that 75 basis points, this pullback may very well just drop us right back down into that 3600 again. Notice how the market didn't respond to Meta. Right? Everybody was really concerned about Google and Microsoft and, oh no, they're going to take down the market, and just buoyed right back up again. Now there's a lot of reasons for this, but they took the move in Facebook yesterday like a mosquito, just swatted it away as nothing. No big deal. Apple, on the other hand, and Tesla is still on the docket, and this unwind, this unrealistic unwind of the 25 basis points. So the base case argument is we're still in the bear market rally. This is still the current low that we're going to hold, right? What I've been calling it, a short-term low that we're going to hold until we get closer to, or until we get to FOMC. Let's say it that way. And between now and FOMC, right? Because we're getting there. It'll be next week. Is that right? This is the 27th. 1 week out would be, next Wednesday. Because we're in the dark period. We're in the blackout period. So between now and next Wednesday, we're either going to finish this bear market rally, or it's done already, and we're just going to kind of chop around here. Make no mistake about it, though, the low that we have on the year is not going to be the low. All right, so we talked about the 50-period moving average yesterday, and this white moving average here is a 3-period. It's a very, very tight moving average. it's a part of the surge system, right? You got surge, momentum, trend, and strength. So 4, 10, 20, 50, 200. And the lineup that we have right now is the 4 over the 10, 10 over 20, price over all of them. And that kind of lines us up as a really strong run until we get into these descending bigger moving averages like a 50 or a descending 200. So one of the lines today in the sand that we don't want to see crossed is getting below the 4-period moving average on a daily time frame. And you can plot those on the intraday, right? We've talked about that before. On Thinkorswim, just type in the word daily, and you'll see that there's a number of indicators with the name daily in it, but one of them is the daily SMA. I created a daily EMA. It's in the Thinkorswim workbook because, you know, I wanted the choice of using both. But you can use this to see the moving average on the intraday charts, right? So it's like TrendSpider. You can see higher time frame indicators on your lower time frame chart. A break of the 4 will aim for the 10. We talk a lot about how far away from the 10-period moving average we are. And when we happen to get, quote, too far away from that 10, we very often will pause and let the 10 catch up, or we will reverse and move back towards the 10, which we would consider the mean or the average of price. So we might get that opportunity today. As you can see, we're inside day, not much of a surprise. We're getting close to challenging the RTH low of yesterday, and beyond that, we will then challenge the Globex low of yesterday. And what we already found this morning was the cash open of yesterday. The open is one of the most overlooked pivot points that has a lot of value. Everybody really focuses more on, you know, the Globex open. But the cash open, I mean, that's a pivot worth marking. So from this inside day, we're going to be focused on that moving average. Which today happens to line up really close with the low, kind of in between the Globex low and the cash low, 38.27, which is nice because now we have just one more target to aim for. All right, so break the current low, which is the cash open of yesterday, break RTH low, cross through the 4-period moving average, and then cross through yesterday's low before we get a little closer to the ADR half and then the ADR full. Now, something I haven't mentioned in a while, but I always like to bring up is how much more we understand about the market when it goes sideways than we used to. And it's because of this indicator called the RSI Laguerre. And it's an interesting indicator because it taught us a lot about the market, but it measures the market in a way that most indicators don't. You know, if you have 9 indicators that are all reading volume, for an example, and even though they all show you a different outcome or they look different, they're all reading volume. So you're not getting 9 different perspectives of the market, you're getting 9 different perspectives of volume. And multi-collinearity would be an issue if you're looking at a bunch of different indicators, but all of those indicators are all looking at one thing. Volume or price are the two most readily accessed things when it comes to indicators. Almost everything looks at volume or price. Volume or price. The RSI Laguerre is a little different than that. The language behind it's a little different. The coding is actually using rocket science math, which is a little odd and funny. But it comes down to the idea that when a market is sideways, what we learned about that is that it's actually building energy. It's like, how much fuel does the market have, or what's the battery level of the market, right? When you're topped out, you have enough energy to do things like break through resistance, as opposed to, not being able to break through resistance because you just don't have the energy behind it. Energy is a weird name or a word to use, because most indicators use things like trend, momentum, inertia. They don't use words like energy. And when it comes to a market actually beginning to make a move, it would be the difference between throwing a ball to somebody and watching that ball lose energy as it spins through the air, and dropping a ball off of a building and watching that ball pick up speed and energy as it moves, right? So when price makes a move, we kind of want to answer that question. Is it moving with energy behind it? Or is it moving to pick up energy? And that RSI Laguerre can kind of give you that answer. The reason I bring it up is, well, we're sideways and we're building energy up. And that energy that we're building, even though it doesn't promise a direction, once we do begin to break out and the move begins to unfold, it's very likely going to come with a lot of energy behind it. Our ADR right now is 2.5%. That would put us down to 37.45, which would be the low from right around Monday. We've talked about this box for a while now, but this is the box that we've been dealing with, pretty much all of October. And it's the thing that needs to hold. So we don't want to get back inside the box. The box top was a solid resistance for a long time, and it really needs to prove to be a solid support now. And if it doesn't prove to be that solid support and we get back inside that box, I don't think it's going to have the juice to get back out of it again before we end up retesting these lows. We are sideways, but we have reasonably decent volume. It's not distressed, really, really low volume, and it's not extreme, really, really high volume. That's really all we need out of this lower indicator so we could turn it off. We are underneath our daily pivot point, but we are a long ways away from the weekly pivot point, which happens to also be farther away than the ADR. So the plus side of that is if we happen to break the ADR, we then have Monday's pivot, and then below Monday's pivot, we have the weekly pivot point. They're just more places to target, right? And it's not necessarily the idea that we got to hold it till it gets there, or we think it's going to turn around when it gets there. It's more of the idea of, okay, where's the next potential or possible reversal? So we get to a pivot, we deal with it at that point. Are we going to reverse there and move back up, or are we going to break through it? And if we do break through it, okay, now where are we going? Where's the next pivot point, right? We just keep working through the trade. We also have the previous week's high as a part of our pivot class today to work through, right? All these are different stages or classes or classifications of pivot. We got a lot of them. So underneath this, if we do start making moves to the downside, we have a lot of things that should potentially help us out, kind of slow price down. Let's take things the other direction and look upwards. If we can get through our own Globex high, we have the high of yesterday really close to the ADR half, and then we have the ADR full at 39.43. I'm not going to say that we can't get there. We certainly can, but I think a lot of this resistance is going to be in the way. Be a little bit of a fight to get through. See if we got any additional targets. Yeah, cog line 39.11 would be another one that I would be a little cautious of, and then 39.28 would be a good midpoint to aim for. So what we're looking at here in the lower portion is advancing versus declining issues. And it's a math formula. They take how many names that are advancing and they subtract how many names are declining. And it gives you a number, right? And for the ADS-PD, there's the S&P 500. And out of that, we do that math. Well, I added a label because I wanted to know just how many names are advancing. No math to it. No ratio, just, hey, out of 500 names in the S&P, how many are going up? How many are ticking up this moment? We crossed through the zero line yesterday and then managed to pull it back up, and we got about halfway, a little past 250, around 350. 350 sounds good, but the number that we're hearing, that 350, is really advanced versus decline. It's not the label of, or just the number of, how many companies are advancing. So 350 is a reasonable benchmark for, like, quote, an okay day, but it's certainly not a bullish bias, a strong bullish bias. You got to at least get above 450. Then you're getting into really strong bullish presence, and we just didn't get there yesterday. So that was one thing. And in the NASDAQ, it was even worse. The NASDAQ advanced decline here, there's only 100 names. And it's the same thing. It's advanced versus decline. So a benchmark of around 75 sounds good, but that's not enough. It needs to get above that before we start thinking that we're getting into some real solid territory. And by the end of the day, we were actually in distribution. We crossed back down below the zero. I bring it up because look at the financials yesterday. So this is regional banks. It's the KRE. I like this one more than the XLF. It was a range day, 100%. And sure, I mean, we got outside of the range for a little bit, but really at the end of the day, we maintained most of the day inside of that 5-minute open range. And if you take the first 10 minutes, well, that was basically the day right there in a nutshell. So we were getting nothing from financials suggesting that a rally was going to stick. The NY Fang, which is our monsters of technology, opened, dumped hard. Obviously, we had Microsoft and Google, but then everything turned around and we managed to get all the way back up to where we started. It basically reset that liquidity and then faded back off again. What was hard to kind of come to terms with was this absolutely amazing move in the CTIX. I mean, this thing was telling us the market was solidly strong with a lot of flow behind it, a lot of pressure and strength and just constant buying. And then when it all ended, it's pretty easy to see, which is helpful, useful. But I mean, that was really strong. And it was a part of this push. So the flip over was news. That was the Atlanta Fed news that I had mentioned. And yet it still managed to maintain in the day. Come on, Thinkorswim. A little slow this morning. All right, 10-day, 30-minute volume profile. If we break below yesterday's low, we really don't have anything to help us out. There's a huge air pocket of risk here. And we happen to move through those relatively quickly. So with no volume nodes and no volume support to help us out, the idea is that we're very likely going to make it down to 3,700 before we start to see a little bit of help. And I love bringing up this profile because instinctively I look for things like open, high, low, close, and I use those as a pivot point. But if I draw a pivot point off of yesterday's price action thinking that it's going to be a place where we could bounce, and then I come here and realize that there's absolutely no support there at all, then the idea that we're actually going to bounce off of yesterday's low is less trustworthy. Five-day, 5-minute. We call this the 5x5, and I happen to have a few extra days in there right now, just because I was doing some work the other day. But generally, this would be set to 5 days, 5 minutes, and we want to carry forward any of the volume profile information. Value area low, value area high. I generally don't carry those, but I do want the point of control if it hasn't been touched yet, which is why we have this VPOC down here. It's a virgin point of control. Once it's been hit, then I really don't care about it anymore. Just like this one from yesterday, we don't need it anymore. We can take that VPOC off the chart. But we did hit it yesterday, and we made it to the other side of it, the way that we're supposed to with pivots, right? Pivots are not designed as a stopping point. We don't have expectations that we get to a pivot and we're just going to turn right there on a dime and go the other way. Liquidity resides on the other side of the pivot. So we're supposed to go through it to get into the liquidity before going the other direction. That's exactly what we got. I'm going to mark this out real quick and swap over. We're using a volume profile right here, and while that's not where the bulk of the volume was, that was a very large amount of volume, and I want to see something. This is the volume profile. But I want to bring in TPO real quick, and unfortunately, the way that the other chart was with the 10-day, 30-minute, I have a TPO there. But I have to do these individually on this chart. So there's the TPO. We want to do it day by day. We don't want it on expansion. We only need 7 profiles. And we'll make those histogram bars a little tighter. What I wanted to see yesterday, we had that nice collection of volume right there, right? That's why I drew that line. And I wanted to see, did we spend very much time there in relation to how much volume we had gotten? We did spend the time there. There is a volume or a histogram bar representation. So what I was looking for isn't there, but we wouldn't know if we didn't look. the idea is with the volume profile, if the profile shows, and I'm just going to use a random number, say 10 million contracts were traded there, and we had that nice volume profile, and then we turn on TPO and it happens to be really shallow, say it only looked like that, it would represent that while we spent a very small amount of time, we actually had a very large amount of volume, like an iceberg or a ceiling. But nope, it's not what we found. Still, it was worth a look. We're getting closer to, the election time frame, and I continue to bring this up. The pump prices are artificial. They are manipulated right now. The elections generally manipulate those prices because, it makes everybody feel better when fuel prices are low. They tend to blame whoever's running the government at the time when the prices are high. So, when you want to win elections, you do whatever you can to keep fuel prices down. Well, fuel prices go directly to things like inflation. So when the Fed is looking at all of their really slow, backwards looking tools that tell them inflation is abating, and inflation is directly connected to these artificially low fuel prices, when the election is over and the fuel prices go back up, and then of course we're going to be in wintertime, we're going to have all the holiday travel, and generally prices in fuel go up during that time period too. The whole idea that we've been trending downward in our inflation and that the Fed is winning this battle, that idea is going to get squashed, and probably violently. So, continue to keep your eye on oil or crude. Nice breakout right there, literally while we're talking about it. I think its ears were burning. It heard me talking and just wants to show off a little bit. Keep your eye on this thing, especially say like yesterday when things began to unravel in the rest of the market. This did not unravel at all. Held it, it stuck the move, and now this morning it's actually breaking out on a new run. Another one that stuck the move yesterday was 30-year bonds. Not just the 30-year, but bonds in general. And Bitcoin really, it did fade off, but not as much as, say, the S&P and the NASDAQ. And it was odd anyways, because this one led the charge to the upside. Still not done in Bitcoin. I think it's going to lose another 50%, 50. Just cut this number in half before it's all said and done, and that's a conservative number. And the dollar got below 110. Now, it is back above that this morning, and it's certainly something we want to start to watch really close, because yesterday in that sell-off, we didn't see the dollar rise. We didn't see volatility rise. We didn't see the 10-year yield rise, which is probably why we didn't break out to the downside yesterday and expand lower, and why we survived through Meta last night, the earnings in Meta. But if we start to lose control on the dollar and it begins going back up, and the VIX begins going up, and the 10-year yield begins going up, we're going to start breaking levels to the downside. US dollar Japan and US dollar China, both of those helped yesterday in our rally upwards. Those big red candles, those big down days, added with the big down day in the dollar, it really just, it took any weight off of the market and allowed it to buoy if it was going to buoy. And that's a default market state, is markets just want to go up. The only time they don't go up is if there's pressure pushing it down. Well, this was taking the pressure off. But now they're moving back up again. All that work that Japan did to defend their dollar As soon as they quit doing any of that work, it's just bouncing right back up again. Same thing with China. Another thing that about China, they put out a message to their state banks the other day, and they told the state banks, hey, our stock values are really low. Baba, Baidu, uh, PPD, Neo, Chinese companies' stock prices are really low. You need to go out and buy so that they don't go lower, and buy enough of it to make them actually start going up. It's China. They don't get to choose, right? It's not like America where they could say, no, we're not going to do it. So they started buying, and that adds to the overall buying that we were seeing, those buy flows, right? And it continued yesterday. If that buying dries up, it's going to just kneecap all those KWeb names and Chinese ADR names that we've been seeing rally up over the last few days. Remember, even when the monsters of tech was not helping, we had broad buying participation across the market, and we still went up. So we're seeing a little recovery in the dollar. We're seeing U.S. China bounce back, and U.S. Japan bounce back. Euro, it's still above parity for the moment, but the expectation is we're going to break back below that. And, of course, the goal would be back to 9.7 or just underneath that, 9.6. Same thing with the British pound. First, it would just be getting back below 114. But once we get back below 114, we'll kind of revisit our levels down. I mentioned crude volatility the other day. We're still in that squeeze. This is VOVX, and this is the IX10 box that we're playing in right now. We're no longer just inside day, we're IX10. But we're going to be looking for that volatility expansion in crude. And the VIX needs to wake up. It very likely will once these other things start kicking in. Now, the MOVE index only prints once a day, and the MOVE index is volatility for bonds. So replace that name with 10-year yields, and we can see that they've been backing off in the last few days, right, as a part of this rally. And I mentioned yesterday how when we flipped over, the 10-year didn't rally up. Well, we're going to be looking for that to join the fight, right? So the threat today is that the S&P and the NASDAQ go down. What will validate that move is seeing the 10-year come up, the dollar coming up, the VIX coming up. So want to keep your eye on those, right? If they continue to stay flat, or even better, if they continue to go down, then the S&P and the NASDAQ can weather the storm and continue to rise. NASDAQ's already underneath the 4-period daily moving average, and the S&P is threatening to break through it right now. I was looking at some prices yesterday. I'm holding Google puts. I've been in them, I don't know, a couple weeks. And while Google was still rallying upwards, I had to hold those puts in defense, right? So I was selling puts against them. Just kind of, in and out, being nimble with the short puts, trying to make back a little bit of that money. Not all at once, kind of nickel and dime it. And I only had my long puts after Google reported, or as we were coming into the earnings. then it dumped down. Now I've still got my puts, and I'm looking around, what do I want to sell, and maybe even build out a position, setting aside the fact that I have puts in Google, but instead looking at the flow that we were getting yesterday and thinking about what that flow was representing and what I might want to trade. And I noticed we were getting a lot of January 2025 flow yesterday. So when I started looking around, I could see that they were building positions out there, really around the 200 strike. Google at $200 in the year 2025. That's kind of what they're focused on. And we can see that there's nearly 15,000 contracts at that strike. Now, a position like that is not in isolation. This isn't the only thing that they have. They very likely have other things. And what you want to do is start looking around and see if you can find those other things. Now, we never know for sure, right? We don't know what's in their portfolio. We don't know what they're holding. We don't even know who they are, right? Because there's so many different kinds of them and they out there. Different brokers, different governed bodies with different rules and criteria on how they can participate in the market. But we know that a lot of those firms will start with selling something, and then they'll use the credit that they got from what they sold to buy something. Well, look at the cost of these puts. So here, for an example, is a little more than 9,000 puts traded at that 105. So if you sell one put at the 105 and you get, we'll just split the mid here and say you get $2,000 for it. And then you go out and you spend $500 of that buying some of these calls down here. So you spent $500 and you still got $1,500 in credit. Now, as long as the market is above 105 in January of 2025, you're going to get to keep all that credit, that $2,000. Now, since you spent some of it, these calls are either going to make you money or you're going to lose the money you spent for them. But you're still going to come out ahead at the end of the day because you sold those puts. And of course, the worst case scenario is if we're lower than 105, you lose on the puts and you lose on the calls, right? So it's like a double lose. But if you're making a bet that between now and January of 2025 that we're going to be above 105, it's a reasonably decent bet. But it's even better than that. Take that 2,000 and subtract it from the 105. That gets you down to about 85. And then the argument is, do you think we'll be above $85 in the year 2025? And with that in mind, what would you do with that credit? Is the credit alone going to be your ultimate goal, or do you use that credit and spend it on, say, calls? And where do you buy those calls? These are really crazy prices right now that you can get for these. And one of the reasons I had somebody ask, why are you looking that far away? We could sell things closer that would have a better reaction to decay and price action. And that's true, absolutely. But one thing that I learned about leaps, and you kind of get into a whole other world with leaps. You're dealing with second-tiered Greeks and third-tiered Greeks. Is if an institution comes in and buy rights a block of options, they will drop the value of the existing options in that chain by around 10% in the blink of an eye. Poof. Supply and demand, baby. If they come in and offer a whole bunch of supply, costs go down. And if you're the one selling it, this thing is going to drop in value hard when they come in dropping a crap load of options in it. And again, we could probably see that in other parts of the chain too. I was drawn to the year 2025 because of the price action that I was already seeing. Then when you look at the grid too, at where the highest amount of extrinsic value is, it's basically asking the question, out of all of the options that are on Google right now, which ones are the most plump, overly fat, juicy, and ripe? And that, of course, is what we're looking for. When I took the snapshot last night, the year 2025 actually was like kicked off over here, while the rest of these are basically all in line. Well, they were spot on. The actual was 2%, the forecast was 2%, and the previous was 1.25. And if you look at what happened with the euro dollar after the report, I love how they do that. That just tickles me in all the right places. McDonald's and MasterCard report. Yeah, baby. You still got some solid moving averages underneath there. So for those of you who don't trade Forex but want to kind of participate, you can use the ETF. And on Thinkorswim, I believe you've got a watch list already provided by Thinkorswim that gives you nations and currency, or at least nations and ETFs. If not, I built one. It might not have every name in it. So here's FXE for the euro. We were talking about Japan the other day. There's EWJ. There's also the FX series, like FXI, FXE, FXC. So you can play either through iShares or Invesco. I've had people ask, well, which one's better? To me, I judge things by their liquidity. So when I go into the options chain, I'm looking for, options liquidity that tells me that one of these is better than the other. Usually when I'm trying to find an ETF, I just go to Google and type in what I'm looking for. That's a really good way to go. But the ETF is likely to move inverse of whatever it is that whatever pair you're trading. So if you think, for an example, that U.S. Japan is going to go back up, retest the 151, break out, and start getting into the 155 area, that's an upside move in the pair. You would want to trade the ETF short. FXY has some really good liquidity, and it's really been failing to get through this candle from that defense day, right? That's kind of the benchmark for the reset. So on that day, that was Friday. That's where they were doing all that defense, all that work that they were doing. Once they stop and the pair starts to go up again, we're going to expect this to reject off of this resistance and continue working its way down. So there's a nice little trade setup there, right? And we've got a market maker move right now. Not just our regular ADR, but an additional market maker move, which is pretty awesome on a product that doesn't really have a very high beta, or it just it doesn't have a very high ADR. So to me, this is lining up for a nice reversal. But it's all predicated on the idea that U.S. dollar Japan is not going to come back in and defend again. Now, their benchmark that they came out with like 2 weeks ago was the 145, and they said that they won't tolerate it above 145. And of course, right after they said that, count back the amount of weeks. It was near the 1st of September when they did that. So it was back here, and they said, that's it. We're not going to tolerate it above 145. And it held there for a while. And then, it didn't. Something's going to break if we keep moving like this. All right, as IBD talks about frequently, a good double bottom should go lower than the double bottom, and that's exactly what we had here, right? Here was our bottom. We came back down, and we went through that bottom first before coming back up, and that's the way a good double bottom is supposed to work. And I always mention, when I was new, I honestly believed that it was supposed to stop, that it was supposed to come down and bounce and go up. And whenever it broke through, I would think, oh man, it didn't work. It broke. It failed. And I used to think that this was bad. But it's a good thing. It's supposed to do that. When it doesn't do that, you should be worried and more concerned about the outcome. So classic, perfect double bottom. The idea being we're going to expect the dollar to rally back up through here. And if you want to trade the dollar and you don't want to use, say, the UUP, and this you can't trade this. But if you wanted to trade without using the UUP, then there's the Smalls Exchange. It has the futures dollar. It's a new Smalls product. So you can participate in trading the dollar using the Smalls. You can also trade the 2 and the 10 and the 30-year bonds using the Smalls. And you can trade yield curves like the 210 or the 230 or the 1030, which is pretty cool. We do have a gas report today, and natural gas is down 1.5%. This thing was an awesome short. And of course, we came into that critical low, talking about double bottoms again. Went through lower than than the previous low, just like we should. Starting to come back out of it, but I don't think we're done with this move lower. I don't think that's the end of the road there. Oh, and speaking of shorts, I don't know when the buying is going to stop, but the moves in Baba, Baidu, those were banks being told to buy it. Well, how long are they going to do that, and when's it going to end? And that'll turn out to be a nice short. If you look at Baba, that's the lowest that it's ever been, right? So first touch, first blush, we get down there, bounce, and then we crash through, right? So, looking for that rollover play. And right now we've got this gap. That's a gap down on a weekly. It's like, I heard it say the other day, that's the kiss of death, right? So, like Rocky said, I ain't heard no bell. We ain't done here yet. Could get a nice retest, though, off that 72 first before rolling over. I'd probably be pretty confident to start with some credit spreads. And then once the rollover does come in, use that credit, maybe buy some puts. Got Baidu here. It managed to pull back off of that historic low. It did set a new low, though. And the only thing slightly concerning is if we're talking about those double bottoms and how it's supposed to go lower before it comes up, we could see, a fairly sizable rally up off of that low, but it's still not done, right? Maybe you want to wait on this one a little bit more before taking the short. But I think there might still be some meat on the bone. Gap down on a weekly, kiss of death. You still have to be at least a little bit concerned about how far we've fallen and how quickly we've fallen, and that it's almost due to move to the upside just from linear regression and mean reversion. So some patience, let it actually roll over and begin making that downside move first, then take the play. But say credit spreads above the top of the gap wouldn't necessarily be a bad idea, around that $90 mark. Maybe let it get closer to the $90 spot so that your credit spreads aren't so far out of the money. Did that gap get filled? Nope. So Neo also gap down on a weekly, still unfilled. There's the 5-bar rule that I would be a little bit concerned about here. It's the first thing that came to mind when I seen this. We are well beyond the 5 bars at this point. Got to kind of have an expectation that it's going to make at least some move to the upside before it continues lower, and that's if it continues lower. I'd be a little more cautious with Neo. But we did get this gap closed from way back here. So that one's no longer on the table. All right, the 50% retrace on Google has been hit. 618 is kind of the goalpost for right now, which it has been since, I don't know, January, February. You can go back and watch my morning briefings from back then. I had my targets, even back then, around that area in Google and NVIDIA, about the 618 on that retrace. We still got room to go. I don't think we're done yet. Speaking of NVIDIA, it got a little bump today to the upside on the idea that if the Meta or Facebook is going to spend a lot of money on that metaverse, that NVIDIA would be the one to um, really benefit from that, right? Cost wise, the money that Facebook is going to be spending to build that out, a lot of that money is going to end up in NVIDIA's pocket. That's where this move to the upside comes from. I don't think that what we're looking at has anything to do with that. We'll flip back over here. That move, yes, very likely is from the ECB decision. It could have something to do with the jobless claims, and there is President Lagarde is speaking, or chairman, or whatever they call her over there. But it's all based on news coming out of Europe, yeah. And then of course we got, you know, our own econ this morning. Remember, bad news is good and good news is bad right now. All right, so we got a strong showing in the financials. It's one of our two sectors that we need, right? If we're going to see a rally in the S&P and the Nasdaq, we need to have the sectors come in and do all the heavy work. There's two risk-on sectors that really matter: financials and technology. So energy's leading the way. You kind of get through energy, you've got industrials, and then past that, you've got financials, and then semiconductors, in a large part, probably the NVIDIA move causing that to come up. Some more defense, utilities, small caps, IWM. Way down on the list, you've got technology. So a long ways down on the list. We don't want to see another divergent day where we have finance versus technology, right? We need these two to work together. All right, nice reflex here in China. So all that work that they did, China and Japan, it's getting unwound. All right, everybody, that's a wrap. Be careful, be safe. Watch the clock. We got a lot of auctions today as we come into the midday. And continue to keep your eye on, especially today, on that Fed Watch tool. Look to see where they're pricing in and if they still believe that the 50 basis points going to be the November rate hike, because that has a lot to do with the rally that we've been seeing over the last few days and how strong it's been. Even with all the negative things going on around us, we still didn't dump, crash, and burn, and that has a large part to do with it. It's not the only thing, but it certainly is a large part. You don't have to sit there and stare at it all day long, but just visit it, about every other hour or two. Stop by that website, check to see if they're still pricing it in that direction. If things start to change very quickly, those changes will stand out there drastically. You'll see it.